Hello, welcome back to CNBC's Capital Connection. I'm Chloe Cho in Asia.
And I'm Steve Sedgwick in Europe. Let's move on and get some insight into what's in the mind of David Costa. He is a Dean at Robert Kennedy College and joins us live from Zurich. Very good to see you again, sir. Look, I want to go straight into your comments here in your notes, and you make the point that some European banks are becoming addicted to borrowing at low LIBOR rates and investing in high government yields. How do we wean them off this, sir?
Well, it is certainly very dangerous to have those banks which now are taking money at low interest rate and investing essentially in government bonds. So it is very difficult. I think what the European central banks should try to do, and also individual central banks, should try to really provide some incentive to those banks to lend to small businesses and really get a way for the economy to start, and not simply to use this money to invest in higher yield bonds, which create also a possible danger in the case of nervousness in the bond market, as we have seen in the last weeks.
Well, hang on a second, though. I thought that these same governments that are telling them to lend to small and medium-sized enterprises are the very same governments who are saying you've got too much leverage 30, 40 times, and the very same governments who have said you've got to repair your balance sheets. They can't have everything, David.
It is difficult. There are a lot of things to be done, but at the same time there have been studies recently showing that some of the Spanish regional banks derive more than 50% of their profit from exactly this sort of carry trade, and that's particularly dangerous. So yes, I think they have to be careful about leverage, they have to be careful about a lot of things, but lending to small business doesn't really imply any leverage. I mean, it can be done in an unleveraged way by simply borrowing at a low rate and giving the possibility to good small businesses to prosper in Europe.
Great to see you, David. So this brings down the question. We didn't really have any coordinated policy decisions by G20 officials over the weekend, although they do agree on stronger capital requirements. Given what is happening in Europe, now with Hungary thrown into the mix, what happens to the banks now?
There have been not a consensus about this idea of a bank tax, because it's very difficult on those meetings to really bring a common voice applicable on every jurisdiction. So what happened to the banks? We have different schools of thinking, but one of the takeaways of the G20, I think, was the difference between the American view and the European view, which is not to spend their weight out of growth by increasing government deficit. So I think European banks, there are some difficulties given the comments in Hungary and so on, but there are still quality banks in Europe, and I think again the picture is a bit about putting all the banks on the same category when there are many smallish banks, middle-sized banks, which have very
It's quite a barbell you're looking at here, isn't it? You've got banks on one side and you like platinum, gold and silver on the other side. That's the hedge, yeah?
Yes, for me, I think given the nervousness in the market, whenever you are in equities now, it is good to have a good percentage of precious metals in the portfolio, because they seem to be holding up. So we don't know how it's going to hand if, given the low volumes in the summer, this volatility will continue to September. So having some of the precious metals in the portfolio has paid off in the last month, and it might pay off in the future as well.
Speak to you. Thank you very much indeed for joining us today. Dr. David Costa, Dean at Robert Kennedy College. OK, European